In this video, I'm going to go through what exactly a family office is, how they operate, but most importantly, how their investment principles differentiate from an average investor. Now, I'm not a family office expert. I only spent a couple of years there with a couple of different families, but ultimately, a lot of the things you see online aren't exactly true. Many families keep their details highly confidential. Ultimately, if you're wanting to start your own family office or just invest like one, this skeleton overview of the basics, followed by an in-depth view of the investment principles, will give you a clear understanding of how to navigate that, or thoughts for you to ponder in your own investment portfolio. And the first thing is, don't sue me. This is just general advice. You need to go to my disclaimer, which is linked in the description section of this video. And by going past this point in the video, you agree to be bound by the terms and conditions of the disclaimer. In the purest form, a single family office is an organization which is dedicated to looking after the family's assets as well as toys, organizing the family and having some form of governance, which is set out in what's known as a family charter that sets the purpose of the family office. Family offices often come about when a founding family member has a large liquidity event of an asset sale, or they divest control of an operating business which frees up capital. These funds are then lent or paid into a consolidated structure which effectively holds all of the family's assets. The intent of setting up a family office is really personally dependent on each individual family, but there were a range of common issues which I saw. One of these was key person planning or succession planning from generation 1 to generation 2. The next reason was to unify the family members around a common set of goals or purpose, and the reason for this was that their success led to lost connections or a vacuum of purpose, particularly if they sold a business and the family members no longer work together. In family offices under $100 million, it was common for them to look after generation 1 and 2. And for family offices over $100 million, their plan was to look after generation 2, 3, 4, and 5 and onward. There is often a philanthropic which is aligned to the family office and a structure as to how they deal with charity. Ultimately, the intent is to pool assets and investments and have governance around how money is spent and invested. The idea is that pooled assets with a robust structure would lead to better investment returns. It is also important noting that good transparency and involved decision making from family members help to unify the family. Finally, it is worthwhile noting that asset protection, estate planning, and an exit strategy, commonly known as a glide path, are important functions of a family office, but these aren't often the reasons why founding family members consider a family office. How are family offices set up? Well, there are two types. There's a single family office and a multi-family office. Often a multi-family office is effectively a wealth management firm selling wealth management services to wealthy families. A single family office is effectively the actual organization which is set up solely by the family to look after the family. To enter the family office club, you need about $20 to $30 million, which is dictated by the cost of operating the family office. This is around 1.5 to 2% of your assets under management, meaning that if you have $30 million at 1.5%, this gives you an operating budget for your family office of about $450,000. In terms of the setup, I don't want to get too technical here, but it's common to have one holding company and each family member has shares in the holding company, and this is where the family charter sits. Then you'll have a range of special purpose entities and trusts which are wholly owned by the holding company. I have mentioned a family charter a few times, so what exactly is it? Effectively, it's a document which governs who exactly the family members are, what is the purpose or values of the family, then it goes into discuss the governance, so who makes what decisions and what is the accountability, then the management, which is more about the day-to-day operations of the family office. From here on, it gets a little bit more technical or personal depending on the family, so you can include things like how you revise or change the family charter. You might talk about succession planning or a glide path, how you wind the family office up. You may include things such as philanthropic endeavors, and there can be a whole range of other things the family might want to include in it. But finally, the last thing which you should include in it is subscribing to this channel. Separate to the family charter, there is often another important document called the IPS, or Investment Policy Statement. And again, all family members agree on it, and it is basically a document that sets out the investable assets, asset allocations, timeline and horizon for investment, target returns, other investment considerations such as ethical investing, and finally the delegation, or who can make what calls on the different types of investment. From these two core documents, depending on the family office, there can be a range of other policies. Common ones I've seen have included things like sharing of pooled assets, a payment or employment of family members, philanthropy, and also things like meetings and agendas. Ultimately, it's as big as the organisation, so if it's a large family office, there might be IT or employment policies as well. Getting onto the goods, how do family offices invest different to the average investor? First things first is family offices get rid of conflicted advice. Now, what do I mean by that? Well, as an average investor, stock tips generally come from your stockbroker. Your financial advisor recommends products on their platform, and product manufacturers solely recommend their product. And all the research that you often get about those products comes directly from the person who introduced you the investment. So how do family offices overcome conflicted advice? Well, first things first is they either have someone in-house or an independent third party who will deconstruct the opportunity for them and benchmark it against other opportunities in the marketplace. And this will give them a view on how it sits relative to other possible investments. They also often have a network of connections that they can ring around to and speak to about the opportunity and see if it's being shopped around. Ultimately, to build that network of connections is often a full-time job in itself. As a preeminent family office, it's my recommendation that you work out how to deconstruct deals and benchmark them against other opportunities to see if they're a good investment. Ultimately, even if you're going to pay other people to do it, it's good to have a high-level understanding so that you can at least understand the basics. The next is asymmetric risk, and as an average investor, it's quite common to put a large amount of your investment portfolio into index funds or defensive assets. Now, family offices operated a bit different, where they took a small part of their portfolio and put it in highly speculative but possibly very lucrative investments. This included pre-IPO seed, startups, unlisted businesses, private equity, or turnaround opportunities. When I say asymmetric risk, what I mean by this is that there is a higher chance that they could lose 100% of their investment. This is why they put a small amount of their portfolio in it and spread it across a range of different investments. But if successful, the payoff would often be 3, 4, or 10x what their initial investment was. As a preeminent family office, I am not giving you any form of investment advice. This is just what I saw. This brings me on to my next investment principle, which is that family offices tended to favour direct investment, meaning that if they were taking asymmetric risks on companies, they wouldn't be investing in a fund which were looking for companies. They would be looking for individual companies that they could directly invest into and skip the manager. Average investors would do the opposite, where they would make most of the investments indirectly through a managed fund or ETF. Whereas with the family offices, they were going out and buying properties direct. On the ASX, they were picking individual stocks, and with fixed interest, they were lending directly to borrowers. And there's a range of reasons for this. Mainly, it saved them on paying a manager as an intermediary. There was flexibility on sourcing the deals. And finally, there are some tax planning matters that help when you directly invest in an asset. Now, don't get me wrong, they didn't not invest in funds, but the reason why they invested in funds was different to the average investor. The reason why they were investing in funds was often for diversification out of their core investments, or if they didn't have expertise in a particular area and wanted to take a position. Ultimately, when they were investing and putting large positions into funds, they weren't shy in asking for discounts from a manager. The next thing is pooling of expenses and toys. And as an average investor, I don't think we would have the gaudy luxury of a private jet, a yacht, or a French villa. And family offices do buy these things because ultimately it's a way to enjoy their dividends, to save them time. But most importantly, I say this tongue-in-cheek, depreciate them in a high tax environment. But what can we learn from it? Well, first thing first is that family offices often set a budget at the start of the year and clearly understand the expenses of all their toys. They do this so that when they model out a projection into the future, they make sure that their costs don't start eating into their capital, and this way they can remain wealthy over the long term. The other thing is when they're looking and buying things, they make sure it's based on a timeshare model, that rather than going out and buying 4 different boats for 4 different family members, they might buy one boat and share a quarter between all family members. Ultimately, these 3 things help them effectively save money in the long run, even though these are massive expenses. As a preeminent family office, my recommendation is to know the expenses of your toys, make sure that the cost of your toys doesn't dig into your capital base, and if you have the opportunity to buy a toy with a friend or family member, this might be a financially smart decision. The next thing is capital protection, and in all business and all investing, it involves risk, and it doesn't matter how good you are at investing or picking different investments, at some point in the future, you are going to lose money. The way family offices operate is they want to protect their whole capital first, meaning that they don't want one individual investment that can blow up their entire portfolio. Family offices focus on capital protection first, and what I mean by this is they understand that each individual investment that they make could go to zero and they lose everything, but they want to make sure that each individual investment that they make doesn't blow up their whole investment portfolio. And there is a range of different ways they do this, which I'm going to go through in brief detail. The first simple way is to diversify and not put all your eggs in one basket. The second way is a little bit more complicated. Family offices understand the difference between commercial risk and all other risks. For example, if you are in a lending deal as a family office as a lender, you understand that the deal could go bad and commercially you could lose your money. But separate to the commercial risk, there is a legal risk, and this is a risk which you can manage. So instead of putting a half-baked legal agreement together, often family offices get the right lawyers and the right people with a track record in order to minimize all the other risks. Or the other example is when they invest into a fund, many people would just look at the IM and understand that this is what the manager promises, whereas a family office might dig a bit deeper into the management agreements and the trustee to ensure that all the documentation aligns along with the IM. What are the lessons for the average investor? Well, first things first is you don't want to take what's said to you at face value, get swept up in the excitement, don't cross your T's and dot your I's, and then end up exposing yourself to more risk than just the commercial risk of the investment. These were mainly the investment principles which I spoke about, but there's a whole raft of other things that family offices do well outside of this. The top 3 for me was that they understand delegation, and time is the only thing that they can't get back, so they give the right jobs to the right people. The second thing is they spend a lot of time on purpose and where they want to be over 5 to 10 years. And finally, they do a lot around transparency and making sure that all family members understand where they've come from and where they are going. Finally, the best thing that family offices do, or more important, the preeminent family offices or average smart investors just like yourself watching this, is subscribe to this channel, because I'm going to go through in more detail the things and vetting and due diligence that I did for other family offices, so that you can gain that knowledge and be able to vet deals just like me and understand what is a good investment. So if you are a preeminent family office starting with $1,000, these investment principles and guide will help you get to that $100 million mark sooner. And if you are already a family office, well, I'm sure that this gave you a bit of extra value seeing what other family offices do. So until you set up your next family office or our family office, best of luck, and I'll see you in the next video.